Hello again, traders, and welcome back to the Pro Trader Network. As you can see, this is part 2 in our video series where we are discussing market structure. In this video, we're going to revisit those key price levels or support and resistance, those sore thumb highs and lows, and then we're going to incorporate our top-down analysis and then introduce candle patterns as well that can help give us clues on the higher time frames to prepare us to take action on the smaller or scalping time frames. If you're a swing trader, you would just bump up your analysis to additional higher time frames. And as you've seen in many of my videos before, traders, I do take advantage of time frame relationships. And after I identify support and resistance on the higher time frames, I like to look for other clues as I cycle through those time frames, starting with the daily and going all the way down to my 15-minute chart. And one of the things I look at, especially on the higher time frames that I can react to on the smaller time frames, are candle patterns. So you need to know your candles and candle patterns. And what do I mean by know your candles? Well, if you're using traditional Japanese candles or if you're using Heikin-Ashi candles, you need to know what those individual candles mean as well as a grouping of candles that form a pattern. One of the things I consistently do in my trading, traders, that provides a tremendous amount of trading opportunities is I use higher time frame patterns to confirm shorter time frame price action. And this allows me to get in early, as we know the shorter time frames are going to react more quickly than the higher time frames. But seeing that confirmation of that pattern on the higher time frame certainly gives me a comfort level that I'm trading with the overall market sentiment in the correct direction. Remember, we want to stay on the right side of the market. But the very first thing I always do is I look left so that I can analyze my higher time frames, translate those into my trading time frames or my scalping time frames so that I'm prepared after analyzing my higher time frames when those scenarios begin to play out on my trading time frames. So traders, right now, let's just do a very, very quick review of our part 1 video that we looked at last week. All right, here's our quick review. We know that market structure is formed by the repeatable patterns created by price action. We look at those key price levels. We refer to those commonly as support and resistance. And we know that these create market structure. And traders, as we said last time, these key price levels tend to stick out like a sore thumb, so we call them sore thumb highs and lows. And when price travels to these areas repeatedly, we say these areas are being tested and retested. That's a vocabulary that we learned last time. And of course, we always look left at historical price action because structure leaves clues. Traders, I always think it's best to do this discussion while looking at a chart. So we're going to bring in a chart and identify some key price levels and take a look at some candle patterns and then drill down to the smaller time frames to see if we can take advantage of what we observe from our top-down analysis. All right, traders, this is my euro-dollar daily chart, and the very first thing I'm going to do is identify some key price levels, and then we're going to take a look back at previous market structure and see if any of these candle patterns perhaps left us some clues that we could have taken advantage of on our trading time frames. So the first thing I'm going to do is drag my support and resistance line in, and current price action says that we are testing this previous structure low here at the 2290, 2280 level. Let me pull that down a little bit. And you can see the pattern I would be looking for here, traders, is forming a double bottom with possible divergence. So I would look for a cross up on a smaller time frame to confirm that perhaps this bullish divergence is playing out. Let's bring in some more key price levels here. We had this structure low, previous structure low, and look, traders, we look left, here we go. Actually somewhat of a head and shoulders pattern forming here. Looking left, previous structure low. Let's pull in another key price level right here, and I immediately see a pattern forming here, traders. Here is very, very strong support, and here we have what's known as a descending wedge. And a descending wedge means that price will get stuck. I'm trying to pull this trend line over at this key support level and then eventually break out like it did here. And where did it test first? Notice, traders, it came right back down right here to this previous key level of support right at the 2600 area, 2625 area. I mean, this is no secret, traders. The market does this over and over and over again. And we can see here, let's pull our vertical line in. We had some great crosses all the way down as this market sold off. We had a great cross here, we had a great cross here, and we had a great cross here, all to take advantage of these sell-offs and retraces and then continued sell-offs. So I'm going to get rid of that vertical line. Let's continue to bring in our key price points here. We had some key support here. We had some resistance and support here. Any candle patterns that perhaps may have given us some clues. I see something right here, traders. I see here a potential ABCD pattern playing out right here. Look at that. Market got stuck, but confluence right in that ABCD completion area, our market harmonics, which we'll discuss in another video. But these are exactly the things that I look for consistently in the market. Here, traders, we have this previous area of very strong resistance. This is at the 145 level. Another thing we want to look at, traders, if you're a counter trend trader, we always want to look at divergence. So here we have price right here moving lower, creating a wave in our oversold area down here below the 32, and then we have another low being tested, a lower low, but our oscillator moving up. So of course, bullish divergence right here, traders. So these are exactly the things I look for on the higher time frames, so that in my trading time frame, I want to be on the right side of the market. If I go long anywhere within these 2 or 3 day candles, I know I'm on the right side of the market. Look at these candles right here, traders. Hammer, hammer, inverted hammer, doji, doji, and so on. Know these candle patterns. Look right here. We have an impulse leg up, doji, 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 hammer, continued price action, continued rally right here, a doji, reversal pattern, and so on. So these Heikin-Ashis are really great candles to be looking at when the current momentum is weakening and there's a possible trend change or possible trend exhaustion in the market. I really look for these right here, traders. I really like to see these really long hammers. For me, when I have divergence trading, I really like to see a double bottom or a 1, 2, 3 bottom to confirm that reversal pattern before I trade counter trend. And of course, traders, in conjunction with those patterns, I always try to look for a confirmation of divergence here on my oscillator, either bearish or bullish, depending if I'm going to go short or long. Okay, traders, so now let's zoom into our 4-hour chart. All right, traders, here's our 4-hour chart, and we've left these lines on here from our daily. I'm going to get rid of these at the moment. And let's take a look right here, traders, at current price action. This was a couple of weeks ago. We had this double top with bearish divergence right here. So a great sell opportunity. And look at this candle, a very big doji. And price began to sell off after the close of that candle on our 4-hour chart. So once this candle closed on my 4-hour chart, I can get long on my 1-hour or 15-minute chart and feel very, very comfortable with this bearish divergence that I am trading on the right side of the market. And that's exactly what I look for, traders. So I would recognize this pattern on my 4-hour chart and then incorporate this into my strategy on my trading time frame. I may even bring some fibs in here to look at where this possible retrace might occur. I would look at market harmonics. Like I said, we'll discuss that in another video. But these are exactly the type of setups that I look for, especially when trading counter trend. We have a bull rotation that occurred right here. We have a new structure high, a retrace that didn't quite break this structure high. We have a double top, and then the market just fell off. And we know a double top with bearish divergence is a trend reversal pattern. Let's throw another support and resistance line in here, traders, and look right here. We had this particular area, the 124.50 area, that had some significant support here. And when you know it, the market came right back down, got hung up there, and here we have hammer, hammer, and a doji, and the market just took off and rallied right back up to where? Look at this previous level of support and resistance right at the 2330, 2350. Look left, previous strong support and resistance. So traders, now we would bring in our conditional thought process if we were witnessing this rally and saying, if price retraces and continues, we might throw our Fibonacci tool on here, or we would say, if price rallies after a retrace, where would it be most likely to retest? Well, we know it would be right here, previous strong resistance, and then we would possibly look for another candle pattern to indicate that after that retest, that rally is exhausted, and then perhaps we would have a sell-off or a retrace opportunity. And here's what I'm actually looking at in current price action traders. I have a break below and close below this previous key level of support. But look at my indicator. I am way oversold. My RSI is at the 2187 level, which we know is way oversold. So traders, with this oversold condition on our 4-hour chart, let's drill down to our 1-hour and 15-minute charts and see if this oversold condition might be creating candle patterns or trading opportunities on those lower time frames. So we're going to go to our 1-hour chart and take a look at this condition. All right, traders, this is my 1-hour chart. The first thing I'm going to do is get rid of some of these lines really quickly. But we see some things developing right now on our 1-hour chart. We know that our 4-hour chart is oversold, and right here we're getting a cross of our RSI above our trade signal line, but we don't have that double bottom pattern that we like to see. Let me get rid of this as well. And even though I'm seeing these hammer candles right here and this potential inside bar, got to remember this is at the end of price action. The market closed on Friday. You can see, traders, we have some hammer candles here, but what I'd be waiting for is this candle pattern to create a double bottom and have a cross closer up to my 32 that confirms that this trend is exhausted. I don't take any crosses below my 32 in this oversold area. I don't chase trade, so I would be waiting for a cross right about the 32 after a double bottom or a 1, 2, 3 bottom, confirming this potential rally. But where might price go? Let me pull in my support and resistance lines, and right now I can identify a range right here where price might retrace. So we have this previous support and this previous resistance. We can see that before our non-farm payroll announcement, price was kind of stuck in this range, and then we had this breakout sell-off. But this is where I would look for price to retrace. I could also pull in my fib ratios here and see if price would retrace to the 382 level, and this is a great opportunity to get some quick pips on a very safe counter trend retrace trade. Let's take a look at our 15-minute chart now and see if there are any potential candle patterns and setups occurring there. This is exactly what I love to see. Look at what happened here, traders. I've got 1, 2, 3 hammer candles. I've got a short retrace. I've got a retest of this price level, a short break below and close below. But look at what I have here. Price moving lower, oscillator moving higher out of this oversold area well below the 32. So in a scalping scenario, traders, where I'm looking to make a few quick pips, I would look for price to retrace off of this bullish divergence. And if you trade divergence on a 15-minute chart, you know that a setup like this, traders, can generate between 60 and 80 pips. So let's just mark that level. Let's say from this low, 60 pips is 23.19. I love to see that, traders, because guess where the euro likes to get hung up? At the 80s and 20s. So I would be looking for price to retrace to the 23.20s. I can pull my fib retracement tool in there, and what do you know? 38%, 2307. So that is a beautiful area for a potential target. And look here, we also had previous support. So I would put my profit target right in here somewhere, and I would take that for after this cross right here, traders. I would be in the market. That would be a quick 25 pips, no problem. So that's how I read price action using top-down analysis and candle patterns to get in early on the smaller time frames. But this all originates, traders, from looking at that potential double bottom on the daily chart, following it through all the way down to the 15-minute time frame and getting in early while all the other traders are wondering what is happening with price. So you can pull 10, 15, 20, 30, 40 pips out all day long just by simply looking at your top-down analysis, getting in early in this particular case on a counter trend trade, being conservative, taking those pips out before this Fibonacci retracement level, a very reliable level, off of this bullish divergence created by this candle pattern, price moving lower, oscillator moving up, using a very logical, calm, and rational form of analysis, waiting for a signal. Our signal candle would be right here, traders. Now, I don't trade Friday afternoons on non-farm payroll, but the cross confirmed, we would get long right here, right in this particular area, right at the 2270 area, and we'd be out of here for 20, 25 pips, right at the 2301 or 2300 even handle. No problem. And our stop in this case would be below structure, below that previous low, right around in here. Our stop would be 15 pips, traders, so that's a 1 to 1.5 risk profile with very little to risk, a decent gain for very little work, and again, an obvious setup that we can take advantage of over and over again. Traders, and this is exactly what I mean by the market telling us what to do. The daily chart showed us double bottom, possible bullish divergence. The 4-hour chart, double bottom, possible bullish divergence. 1-hour chart, way oversold, price already crossing up, our RSI just beginning to cross our trade signal line. If we wanted to be extremely cautious and conservative, we could wait for that cross, our RSI crossing above our trade signal line on the 1-hour, and then take this trade, the short scalp on our 15-minute chart for 15, 20, 25 pips up to our Fibonacci 382. This is just basic market structure trading. No stress, no anxiety, and guess what, traders? If we lose, we've only lost 15 pips with a 1 to 1.5 risk profile potential. And that's how you make money in the markets. Letting the markets tell us what to do, using market structure to completely guide our decision making. So no guessing, no hoping, no wishing, no panic. Traders, let me apologize very quickly. I know sometimes my discussions and presentations can seem somewhat fragmented and all over the place, but I am trying to slow down and incorporate all the elements that I use every day when I trade and point out all the nuances of how I analyze market structure, and then I incorporate top-down analysis and candle patterns into that analysis to determine my risk and my potential profit. And traders, I'm so used to doing this, and I know that sometimes when I explain it, it can seem like I'm all over the map. But what you need to do is you need to continue your practice of identifying these key support and resistance levels and starting with the higher time frames and then moving through down to your scalping or trading time frames, whatever those may be. And after we identify that support and resistance, those key levels, we want to look for these candle patterns that can signal reversals and potential retraces, and then quickly identify, which we've already done if we put our support and resistance lines on our chart, these areas that might be retested or where price might tend to gravitate. And you want to incorporate this knowledge in your notes at the beginning of the week, especially from the higher time frames, so that you always find yourself on the right side of the market. And remember, we want to be prepared. We want to have won the battle before we ever begin to fight it. And as I said, traders, being on the right side of the market, we remember that higher time frame patterns confirm shorter time frame price action. So if we have a bullish divergence pattern playing out on the daily chart, we definitely want to be long on the shorter time frames, staying on the right side of the market. And as always, we have to look left so that we can begin to be ready when these potential scenarios play out. And looking left, traders, remember, structure leaves clues. We've identified these key areas of support and resistance, so when we sit down and we look at our charts, we're completely prepared, we're relaxed, we can attack. So when the market tells us what to do, traders, we're just simply seeing and doing. We have no emotional investment, we don't have to think, and we simply follow our rules for entry, follow our rules for exit, and as we know, traders, that mindset translates into consistency and profitability. Great to have you back here at the Pro Trader Network. As always, let's stay focused, follow our rules. We'll see you next time.